Good evening, everyone. On behalf of NISM, I extend a warm welcome to all of you for today's webinar on equity derivatives. I am Neha Deshmukh, representing NISM. It's our privilege to have esteemed industry expert with us today to lead this session. We are especially honored to welcome Ms. Aparna Bhatt, Associate Professor at KJ Somaiya Institute of Management Studies and Research. Before we begin, let me allow to give a quick introduction of our speaker. Dr. Aparna Bhatt is a chartered accountant and holds the Financial Risk Manager certification from Global Association of Risk Professional, USA. She is an associate professor with KJ Somaiya Institute of Management Studies and Research in the area of finance and facilitates course on derivatives and financial risk management and corporate finance. Aparna has a total work experience of 28 years, of which 14 years were spent in the corporate sector in various areas such as audit, finance and accounts, and risk management. Prior to joining academia, Aparna worked for noted companies such as Reliance Industries Limited, SBI Delhi Limited, Security Trading Corporation of India Limited, and National Stock Exchange. Aparna's research interests are in the areas of stock market, financial derivatives, and financial risk management models. Her doctoral research revolved around the pricing and hedging of exchange trading currency options in India. So once again, a warm welcome to ma'am for today's webinar. Some important announcement for the participant. We will take all the questions at the end of the webinar. Please write your queries in Q&A board. All the participants will receive participation certificate within 3 to 4 days. The recording of the session will be available on the NISM YouTube channel. So now, without further delay, I would like to hand over this session to our speaker. Over to you, ma'am.
Thank you, Neha, for that kind introduction. So let me just start by sharing my screen. So this is going to be only a 1 hour webinar, okay? And 1 hour is absolutely insufficient for explaining anything about equity derivatives. So I will just give an overview of this subject because, as you have probably heard, this is a rather complex subject, and 1 hour is not enough to do justice to this. Okay, so before I jump into what are derivatives and the definition and all that, let's just look at two different cases. Okay, so the first case is about a retired person, Mr. Sharma. He's a retired individual and he has some investments in equity shares, in equity and debt mutual funds, bank fixed deposits, etc. Okay. Now, let's say that some elections are going to come, are going to take place in India. Let's say Lok Sabha elections are going to take place. And our Mr. Sharma is worried that the results of these elections may lead to uncertainty in the stock market. Because as elections are a time of great excitement in our country. So there are multiple possibilities, right? What if no single party wins a clear majority? Okay, what if there is going to be a coalition government? And markets, stock markets, or any markets for that matter, currency markets, stock markets, bond markets, none of the markets like uncertainty. So if there's going to be a coalition government, if there is any possibility that, the ruling party may not win a clear majority, what is going to happen? The market is going to crash, right? So our Mr. Sharma is worried that the results of these elections may lead to uncertainty in the stock market. And if there is uncertainty, as you all know, it will affect the value of his equity investments, right? And you all know that this is playing out in the markets right now, right? So every day we have been seeing since I think end of September, the market is falling. Okay, every day we see that the Nifty and the Sensex are going lower and lower, right? So how does this investor deal with this? How should he deal with this uncertainty? Should he sell all his equity investments and sit on cash? Should he do nothing and just wait for this volatile period to get over? Or should he do something else? Okay. So let's park these questions for a while and let's move on to the next case. So the second case is about a young investor, okay, a young professional, Shreya, okay. She is a media manager for a large corporate house. And right now she has mainly investments which are mainly in the form of bank fixed deposits and gold. And she has recently started following the financial news. And it says that the news says that the stock market may start rising sharply this month. And right now, she has no equity investments. Okay. She is totally invested in bank fixed deposits. But one of her fixed deposits will mature by the beginning of the next month. And she plans to invest that money in equity shares. Okay. So she has no surplus money today. She has no spare cash today. But by the end of the month, she is going to receive some money because one of her FDs is going to mature. So she plans to start investing from the end of this month. Now, what is the risk to her plan? Can you think of it? What can go wrong with this plan? She is planning to invest money in the stock market at the beginning of next month or at the end of the current month, right? What could go wrong? What is the risk here? Well, see, the news says that the stock market may start rising sharply this month, right? So the news and all the analysts and everybody is saying that market may start rising sharply this month. So the risk is that if Shreya does not invest today, if she waits for 1 month to invest, what will happen? Shreya would have missed the bus, right? It is quite possible that the market may rise 5 or 10% this month, and by the time Shreya actually gets money in her hand and starts investing, it is quite possible that the market would have gone up 20-30%. Quite possible, right? So the risk, so these two cases which I mentioned, they are different, right? What was Mr. Sharma's case? Mr. Sharma was worried about a fall in the stock market, right? He was worried about if election results are not favorable and if the ruling party loses the election and all that, then the market may crash, okay, over the next 2-3 months. And what is Shreya worried about? Shreya is worried about what if the market goes up sharply before I get my money in my hand and before I'm able to invest, right? So now you know that investors can be worried from two different angles. Investors can be worried about, people can be some people who have already invested in the market, they would be worried about market going down, a fall in the market, right? And those who have not yet invested in the market and who are planning to invest in the future, such people, future investors, they are worried about a future rise in the market, right? Because their problem is that what if the market goes up before I'm able to invest, right? So we have two different situations, right? So what she should do? How should she deal with this situation? She doesn't have, remember, she has no money right now. She has no spare cash, right? All her money is locked up in gold and bank fixed deposits, right? She is going to receive money only at the end of the month. And she's worried that before the end of the month, okay, but before she's able to get the money in her hand, she's worried that market might run up sharply. So how should she deal with this situation? Should she borrow money from a friend and invest it in shares today? Again, should she do nothing but wait for the month to get over and wait for her FD to mature and wait for the money in her hand? Okay, or should she do something else, right? So, what she should do, right? So, in both these cases, the case of Mr. Sharma and Shreya, derivatives are a solution. So what is common to both these situations? So Mr. Sharma is worried about a fall in the stock prices in the future. His fear is that if the election results are not favorable, the ruling party loses the elections, market may crash. And what is Shreya worried about? Shreya is worried about what if the market runs up sharply, runs up 20-30% before I'm able to get hold of my money and before I'm able to start investing. Then what? Both of them have different problems, right? But both these questions can be resolved using derivatives, right? So how can derivatives be used as a solution to these problems? Okay, so Mr. Sharma could either buy put options or enter into a short position in Nifty futures or Sensex futures. So basically what he can do to hedge against a fall in the stock market, he could buy something called put options, and he could also short Nifty futures or Sensex futures. Okay, so these are the options available to Mr. Sharma in the derivatives market. And what could Shreya do? Shreya is worried about a rise in the market, right? So what she could do? She could either by call options or she could take a long position in Nifty futures or Sensex futures. Okay. So both these alternatives. So call options and futures, right? Call options, put options, long position in futures, short position in futures. What are all these things? They are derivatives. Okay. So these are basically options and futures contract. They are nothing but derivatives. So now we come to the definition of derivatives. What are these derivatives? Derivatives are financial instruments that derive their value from one or more underlying assets. And they are basically legal contracts with predefined contract specifications. Okay, so the basic difference is that a derivative is nothing but a contract. Okay, what is a contract? An agreement. Agreement between two people, two parties, right? A derivative is an agreement or a contract which is written on some underlying asset. Okay, so derivatives by themselves are not assets. What are they? They are simply contracts written on some underlying asset, and they allow the buyer and seller of the contract to buy or sell the underlying asset at a predetermined price on some future date, or to exchange cash flows from the underlying asset on some future date. So derivatives is all about doing something in the future, right? So it's not about whether to buy or sell shares today. It is about buying or selling shares, or buying or selling currency or commodities at some point in the future. Okay. If you want to buy or sell shares today, what will you do? You will simply act in the cash market, right? What is the cash market? Cash market is the place where you buy and sell assets as of today. So today, if I want to buy shares of Reliance Industries, I just go and do a buy transaction in the cash market. Okay, but derivatives is not about buying or selling today. It is about buying or selling at some point in the future. So what are the features of these derivatives? The most important feature is that the value of the derivative contract changes with the value of the underlying asset. Naturally. Why? Because its value is derived from the value of the underlying asset. So the moment you say the value of something is derived from the value of some other thing, what does it mean? If the value of the other thing changes, then the value of this derivative contract will also change. All trades in derivatives are settled on a future date at some point in the future. Okay. Trading in derivatives does not require full cash payment on the trade date. So this is the most important difference between buying and selling the asset today vis-a-vis buying and selling the asset through a derivative contract. Okay, so let's spend some time on this point. Okay, so suppose I want to buy shares of some company today. Okay, let's say Reliance Industries. Let's say I want to buy shares of Reliance Industries. Let's say today's price is 1,200. Okay, I want to buy 100 shares of Reliance. What will happen? I'll place an order with my broker. Okay, broker may be a phone broker, like when I place the order on the phone, or it could be some online broker, so that I place an order through my mobile phone, and I place a buy order for 100 shares, right? Now, when will this transaction be settled? Okay, now what do you mean by settling of the transaction? Settling means I'm buying the shares, right? So somebody else will be selling those shares to me. When will those shares come to my demat account? So in the stock market, the settlement is on T+1, right? So tomorrow I will receive the shares in my demat account, and in turn, the money will flow out from my bank account, all right? Because I have to pay for the shares, right? So 1,200 into 100. Okay. So how much is that? 1,20,000. 1,20,000 will go out of my bank account. So the settlement will happen tomorrow itself, T+1. Okay. So when I am buying the actual shares, I am paying the full amount. But suppose I don't want to buy the shares today, right? I want delivery after say 1 month. I want the delivery at the end of this month. Okay. Or so what I do, instead of buying the shares, what I can do, I can buy a futures contract on Reliance, right? And if I am buying a futures contract, this is not like buying the shares itself, right? Buying a futures contract means what? Basically entering into an agreement to buy the shares of Reliance on some future date, which might be 1 month from today, it might be 2 months from today, it might be 3 months from today. So basically, I am entering into an agreement to buy the shares 1 month from today, let us say. Okay. Now, when I'm buying a futures contract, what am I doing? I'm not actually buying the shares today, right? I'm simply entering into an agreement. So the thing is that I don't have to pay the full price, right? I don't have to pay 1,20,000 today because I'm not getting delivery of the shares today, right? I'll be getting delivery of the shares only 1 month from today. Therefore, whatever derivative contract you enter into today, be it a futures contract or an options contract, you don't have to make the full cash payment on the trade date, right? So these are the main features of derivatives. Okay. So there are four basic types of derivatives in the world. Anywhere in the world you go, there are four basic types of derivatives. The first is the forward contract. The second is the futures contract. Then there are something called swaps, and then there are options. So these four are the basic types of derivatives. And when we say the derivative is a contract written on some underlying asset, what kind of assets are we talking about? So these underlying assets could be anything. They could be metals. Okay, so something like say copper or aluminum or zinc or nickel. They could be energy resources. For example, crude oil, natural gas. They could be agri commodities. Okay, so cotton, wheat, sugar, coffee, or they could be financial assets like stocks, okay, currencies and bonds. So that's about the derivatives. So why is this market needed? So we already have a cash market, right? So as I said, there are two types of markets. Cash market is the market where the market for immediate buying or selling of the asset. So like I said, if I buy shares of Reliance, okay, then that is a transaction happening in the cash market because I am buying the shares today itself and I'll get delivery tomorrow. I'll make the payment also tomorrow, right? So we already have a cash market. So why do we need a derivatives market? Okay, so the basic purpose of derivatives, why this market came into existence was to enable transfer of risk from participants with a low risk appetite to those with a high risk appetite. Okay, so there are all kinds of people in the world, right? Some people are risk averse. What do you mean by risk averse? They don't like risk. Okay, they want to minimize their risk. And there are some other people who just love risk. Okay, they like to embrace risk. And why? Because they know that higher the risk you take, higher is the profit that you stand to make. Okay, so there are all kinds of people in the world. So the derivatives market enables the low risk appetite people to minimize their risk. Okay, by transferring their risk to those people who are ready to bear that risk. And the derivatives market enables better price discovery. What do you mean by price discovery? So price discovery is basically, it means like understanding or determining the fair price of some asset. Okay, so for example, uh, let's say, let's say I have a house somewhere in the foothills of the Himalayas. Okay, there is a small village, and let's say there is an old house which I own there. Okay, it's a very old cottage. It's in a remote village in the Himalayas. Okay, let's say I am planning to sell that house. Okay, will it be very easy for me to sell that house? Will I find a ready buyer for that house? Will it be possible for me to find out what is the market value of that house as of today? Yeah, not at all easy. Why not at all easy? Why? Because we don't have a ready market for houses, right? We have like, you know, have you ever seen a marketplace for houses? Okay, so it's very difficult. Okay, so because on a day-to-day basis, we don't have a market where houses are bought and sold, and very clearly, transparently, you see the price at different locations. It's very, very difficult, right? So price discovery is not possible in the real estate market. Okay, price discovery is not very efficient in the real estate market because we don't have a ready marketplace. There's no electronic website where you can just log in and see, okay, what is the price of a house in Kasoli, okay, or somewhere like that. So in the derivatives market, on the other hand, it's a very liquid market. What do you mean by liquid market? Liquid market means a market where there are a large number of buyers and sellers, right? Large number of buyers. See, when do you say a market is liquid? Market is liquid when it is possible for you to buy a large quantity of that asset without driving up the price sharply, or when it is possible for you to unload a large quantity of some asset, okay, sell a large quantity of the asset without the price hitting the floor, right? So derivatives market is a very liquid market because there are like literally like huge number of buyers and sellers operating in this market, okay? And because of the presence of huge number of buyers and sellers, the price discovery is very efficient, so it is very easy for to establish the fair price of some contract in the derivatives market. And it allows shifting of trades from the unorganized market to the organized market. Now, what do you mean by unorganized market? So, unorganized market means that unofficial market. Okay. So, before derivatives were introduced in India, derivatives were introduced in India, say in the year 2000, right? So before that, derivatives existed in India in some form or the other, but they were not called derivatives. There was unofficial market. Okay, you might have heard of terms called badla, so in Harshad Mehta times, there used to be a big market in badla and badla and all that, right? So those those were unorganized derivative markets, right? So now in 2000, in the year 2000, when SEBI allowed the introduction of derivatives, then all this became official, okay, organized market. And it's always safe to trade in an organized market. And why? Because we are going to see later, there is protection. When you trade in an organized market, you are protected, okay? Nobody can cheat you or default you, commit some default or something, okay? So existence of a proper derivatives market allows shifting of trades from the unorganized market to the organized market. Okay, so who are the participants in this market? So basically, there are three kinds of participants. There are hedgers, speculators, and arbitrageurs. Now, who are these hedgers? Okay, so hedgers basically they use derivatives to minimize the risk of adverse price movements in the equity market. So, for example, in our case, Mr. Sharma, he is a hedger. Why is he a hedger? Because he already owns investments, right? And he's worried about what will happen if the election, results are bad and all that. So I want to protect my investments against an unfavorable price movement. He is a hedger. Okay. Who's a speculator? Speculator is somebody who wants to make a profit from anticipated price changes in the underlying stock. Okay. So let's say there is a company which is going to announce its quarterly results tomorrow. Okay. And let's say I have a feeling I have been studying this company for the last 2-3 years. Okay. And I have formed an opinion about this company. I feel that tomorrow the company is going to announce spectacular results. And my opinion is that after the declaration of results, the stock price is going to run up at least by 10%, right? So what I want to do, I want to quickly buy this stock and make a profit. Okay. But as I said, instead of buying the stock, I might decide to take a long position in the futures, in the stock futures, or I might decide to buy a call option, right? So what is my intention? Now, don't worry about what is this long position and what is a call option and all that. We will see that later, okay? But what is my objective here? My objective is to make a quick profit based on anticipated price changes. Okay, so I am a speculator. And the third category of people are arbitrageurs. So what do these arbitrageurs do? So in any market, in economics there is something called the law of one price. Law of one price. What does that say? So it says that basically if there is a commodity or if there is any asset which is trading in two different markets, it has to trade at the same price. Okay, it has to trade at the same price. And if there is any slight difference in the prices in both markets, then what you can do? You can do something called an arbitrage transaction. So what is an arbitrage transaction? In an arbitrage transaction, what you do is that you buy the asset in the market where it is slightly cheaper and you sell it in the asset where it is slightly more expensive. A typical example would be, let's say there is a company whose shares are trading both on NSE and BSE. Okay. And let's say on the NSE, the shares are trading at say 100 rupees and on BSE, they are trading at 99.50. Okay. Now somebody who spots this difference, okay, at the same moment, they are trading at slightly different prices on both the exchanges. So what can somebody do? Somebody can quickly buy those shares on BSE and sell them on NSE for 100 and make a 50 paisa profit. So that is what is done by arbitrageurs. Okay, so basically three types of people trade in the derivatives market. So I mentioned before that there are four basic kinds of derivatives: forwards, futures, options, and swaps. So forward contract is the earliest derivative contract. Okay, why was it created? Mainly to protect the farmer from the risk of falling agri commodity prices. Okay, so the earliest derivative contract was the forward contract. Let's say there is a wheat farmer and he's planting the wheat in November. Okay, and he expects to harvest it in March. So over there are 4 months, right? Sorry, 5 months, November to March. What is the risk this farmer is exposed to? What is the risk he's facing? See, he's planting the crop. Say, let's say today we are in November. He's planting the crop today, right? But the crop will be ready only in March, after 5 months. So what is the risk here? Well, there is a lot of risk, climate risk and all that, but the main risk is of the price. Okay. So let's say today the price of wheat is say 21, let's say the price of wheat is say 22 rupees a kilo, right? And he's worried that what if there is a bumper crop of wheat this year? If there is a bumper crop, what will happen? Obviously, the price will go down because demand and supply. If supply is very high, the price is pushed down, right? So he is worried. What if the risk, wheat price falls to 18 or 19 in March? Then the farmer will not be able to recover his whole cost, right? So that is the risk he is exposed to. And on the other hand, let's say there is a company like say Britannia, okay? There is a company which is making biscuits and confectionery, and for this company, wheat is a raw material. So it continuously requires wheat for its operations. So what is the risk which this company is exposed to? The company's risk is opposite of that of the farmer, right? The farmer is worried about wheat price going down, and this company is worried about an increase in the price of wheat, because for it the wheat is a raw material, right? So if wheat price goes up, okay, the company's profit margins are going to be squeezed, right? So they have opposite risks. So what these people can do, both these people, the farmer and the company, what they can do, they can come together and enter into a forward contract. Okay. So they can enter into an agreement under which the farmer will sell 300 kilos of wheat to the company on 25th March at a price of 22 per kilo. Okay. So what are the terms of this contract? See, when are they going to sell the wheat? When is the farmer going to sell the wheat? Not today. Today we are in November, right? So the buying and selling will happen on 25th of March. So it will happen on some future date, and the future date is mentioned in the contract, right? And how much quantity? 300 kilos. So the quantity is also mentioned in the contract. And what is the price? They are agreeing upon a price of 22 rupees per kilo, right? So in this contract, the buyer and the seller, they are agreeing to buy and sell the underlying asset. Here the underlying asset is wheat, right? And the buying and selling will happen on some future date, and the price at which the buying and selling will happen, that is also agreed upon today. Okay, so this is a forward contract, and the agreed price of 22 rupees is known as the forward price. And the date of settlement of the contract, when is the contract going to be settled? On 25th of March, right? That is known as the maturity date or expiration date of the contract. Okay, so this kind of contract, it is binding on both the parties. Okay, so both the parties have an obligation under the contract. The farmer has an obligation to deliver 300 kilos of wheat on 25th of March, and the company has an obligation to pay 6,600. How did I get this number? 6,600, 300 kilos into 22 rupees per kilo, right? So the company is bound to pay 6,600 to the farmer on receiving the delivery. Okay. So there is a contract and both parties are bound by it. But this was the, so as I said, this was the earliest type of derivative contract. But so this type of contract has its limitations. What are the limitations? There is a possibility that either party may default. Okay, what if there is, unseasonal rainfall or something, or the crop goes bad, and let us say the farmer was not able to, harvest 300 kilos of wheat. What if his harvest was only 100 kilos? So the farmer may fail to deliver the promised quantity. Okay, so there is always a possibility that one of the parties may default, right? So the market, as a whole, they came up with this idea that why don't we have standardized contracts? Okay, standardized contracts known as futures contracts. So what is a standardized? So what is the main difference between the forward contract and a futures contract? The forward contract is negotiated on a one-on-one basis. That means what, every farmer and every company could have a different contract. Okay, so this particular contract, it was going to be settled on 25th March. Some other contract between some other farmer and other company may call for delivery on 1st of April. Okay. And so different parties will negotiate different terms according to their convenience. Okay. So a forward contract is a non-standardized, or it is a customized contract. Okay. But what they said, instead of having non-standardized or customized contracts, let us have standardized contracts for every commodity. So every contract for wheat will have the same terms and conditions. Every contract for coffee will have the same terms and conditions. So these standardized contracts came to be known as futures contracts. And instead of being, traded between two parties, okay, all these contracts started trading on a common trading platform known as a futures exchange. So that is how a futures exchange was born. So the way we have a stock exchange, okay, in the US, stock exchanges and futures exchanges are different. Okay, so for example, when we say NYSE, the New York Stock Exchange, right, that is a stock exchange. So that does not, so futures contracts are not traded on NYSE. So where are the futures contracts traded? In the US, the Chicago Mercantile Exchange. Okay. That is the place where the futures contracts are traded. Okay. So in the US, the futures exchange is different from the stock exchange. But in India, both the products, stocks and futures, both are traded on the same exchange. So we don't have a different futures exchange in India. Okay. Now, every futures exchange set up its own clearing house. Okay, so when the futures exchanges were born, at the same time, clearing houses were also born. Okay, so every futures exchange has its own clearing house, which looks after the settlement of these contracts. Okay, so what are all these clearing houses? Let's look at them. We will look at it later. Okay. So that is the futures contract. But what again, the futures contract has a limitation. What is the limitation? The futures contract eliminates the risk of counterparty default, but it locks in the farmer's selling price and the company's purchase price at 22 rupees per kilo. So both are bound. So as I said, the farmer is bound to sell his crop at 22 rupees, right? But what if the farmer has some other customer who is ready to pay 25 rupees for the wheat? Okay, now the farmer won't be able to do that because he has already entered into a forward contract and promised to sell his wheat to the company at 22, right? So farmer cannot escape that. Okay, so what if the farmer wants the freedom to sell his wheat at a higher price than 22 rupees? Okay, and what if the company too wants a freedom? The company has promised to buy it from the farmer at 22, but let's say the company comes across another farmer who's ready to sell the same wheat at 20, right? So company also wants the freedom to be able to buy the wheat for a lower price than 22, right? So how is this possible, right? So by entering into something called an option contract, both these parties, they can minimize their risk, and at the same time they can have the freedom to transact at a more favorable price, right? So this is an options contract. So let's say there are two types of options. There is something called a call option. What is this call option? It is a contract which allows the holder of the call the right to buy the underlying asset at a fixed price, okay, on or before the expiration of the contract. And a put option is a contract that allows the holder of the put the right to sell the underlying asset at a fixed price on or before the expiration date of the contract. Okay. So now tell me in this example, which option should the farmer buy and which option should the company buy? Any idea? So let's look at the farmer's problem. What is the farmer's problem? He wants to be sure that he's he's ready to, yeah. So farmer would buy a put option, right? Farmer would buy a put option. Why? Because he wants the right to sell his wheat at 22 rupees. So if the market price of the wheat were lower, let us say if there is a bumper crop and the market price of wheat is say 20 rupees or 19 rupees, the farmer wants the, guarantee that he will be able to sell his wheat at 22 rupees, right? But at the same time, if the market price is higher, then the farmer, what will he do? He will ditch the put option, he will let the option go waste, and he will sell the wheat in the market at a higher price. And likewise, the company wants to be sure that it will be able to buy wheat at any time at 22 rupees, right? If the market price is say 25 or 26, company wants to be sure that it will get its wheat at 22. But if the market price is lower, say 18 or 19, what will the company do? It will sacrifice the call option. It will let it go waste and it will buy the wheat at a lower price. Okay. So there is an inbuilt flexibility in the option contract. Okay. So basically these are the this thing. And the fourth type of derivative is the swap. Okay. Here this is a contract which is it is quite sophisticated. It is mainly used by financial institutions like banks and companies, right? And typical examples are interest rate swap and currency swaps. And these are the mainly, interest rate swaps and currency swaps are mainly, the prominently traded in this market. Equity swaps are quite rare. Okay. So where are these derivatives traded? So, in the derivatives market, there are two types of markets. Okay. There is something called the OTC market and there is something called the exchange traded. So OTC market is the one where the transaction is between buyers and sellers directly. Like I said, the forward contract, right? Forward contract was negotiated directly between the farmer and the company. But when the derivatives traded on an exchange, okay, then there is no direct face-to-face negotiation between buyer and seller, right? Because the exchange comes in between. So exchange is known as a central counterparty, okay, because it stands between the buyer and the seller. So all these derivatives, they can be either traded on the OTC market or on the exchange traded market, and some contracts like options, they are traded on both the venues. And this is basically the history of derivatives in India. They were introduced in 2000 and 2001. And for most of the time, we only had monthly derivative contracts. Weekly derivatives were introduced for the first time in 2016. And they became quite popular. And recently, SEBI has made some changes to the derivatives framework and it has directed exchanges to discontinue weekly contracts on many indices. Okay. So derivatives trading in India has a very short history, about 25 years, but it has become very popular. So briefly, let's understand the structure of this market. Where are these derivatives traded? So there is an online screen-based nationwide trading platform. Okay. So we have BSE, NSE, and to some extent the Metropolitan Stock Exchange. So these are the exchanges where the derivatives are traded. And as you know, it is screen-based trading. There are anonymous orders executed, right? So obviously, because it is screen-based, the buyer doesn't know who is the seller and vice versa, right? There is an automated order matching system which matches the buy and sell orders, right? And all these trades are guaranteed settlement, okay? So the settlement of all these trades is guaranteed by the clearing corporation, which is an arm of the exchange. Now, in the derivatives market, all trades have to be routed through registered members. So we call them brokers, but all these brokers are basically registered members of the exchange. They are known as trading members. So every broker has to be a trading member of the exchange. He has to be registered with the exchange. And whenever you place an order as a client, okay, you place an order to buy or sell some derivative contract, this order has to be routed through the broker who is the trading member. But in the derivatives market, there is a three-tier structure. Okay, so all the trading members, they settle their trades through the clearing members. Okay. So we have clearing members, and below them we have trading members, and below them we have the ultimate client who is doing the buying or selling. Now, clearing members, there are different kinds of clearing members. There are some members who are trading come clearing members. That is, they not only trade, they also clear their trades. Then there are some certain other clearing members who simply clear their trades. Okay. And then there are professional clearing members like banks who only clear the trades of others. Okay. What is the responsibility of the exchange? The exchange provides the platform on which the derivatives are bought and sold, the contracts are bought and sold. And in return for providing this platform, the exchange collects transaction charges from the brokers who are trading on the exchange. The exchange is also responsible for collecting securities transaction tax, because you know that we have to pay STT on all those derivatives. Okay, whatever derivatives we trade on the exchange, they are subject to STT, and the exchange is responsible for collecting it and on behalf of the government. Now, in the equity derivative segment, derivative contracts are available on multiple stocks. So I think somewhere around 200 or so, 200 odd stocks are eligible for trading in the derivative segment, and also stock indices like Nifty, Sensex, you know, Bank Nifty, Bank X, all these are the indices, stock indices on which derivatives trading is possible. How are these stocks selected? So there are so you know that there must be about 5,000, 6,000 listed companies, okay, in India, whose stocks are available for trading. But derivatives are not available on all these 5,000 or 6,000 stocks, okay. Derivatives trading is possible on a handful of stocks, maybe 200, 250 or whatever. So there are very stringent conditions which have been laid down by SEBI for deciding whether, you know, derivatives trading should be offered on a particular company stock or not. Okay. Only when these conditions are satisfied, then that stock enters the derivative segment. So over the past 25 years almost, you can see that this market has grown by leaps and bounds, and today it is a very liquid market with a wide variety of participants. So this is basically how the life cycle of a exchange traded derivatives trade happens. Okay. The first stage is the decision to trade. Obviously, the client decides to buy or sell some derivative contract, and then he places a buy or sell order. How does he place his order? Maybe over the phone or maybe through his online app or whatever. The order is placed with a broker. As I said earlier, the broker has to be a member of the exchange, right? So the order is placed with the broker, and then the broker enters the order in his system, trading system. And you know, all these trading systems, they are basically the trading terminals, okay, the computers in which the orders are entered. All these trading terminals are linked with the server of the exchange, okay. And so once the client's order is punched into the system, the order goes and enters into the electronic trading book of the exchange. And there the exchange will match the order. It has a matching engine which will match all buy orders with all sell orders, right? And once the order is matched, we say that the trade is executed, right? And after the trade is executed, the clearing house of the exchange will do the clearing and settlement of the trade, right? And then finally, on the expiration of the contract, the final pay in or payout will happen. Okay, so roughly what are the steps? The first step is obviously order placement. So different types of orders are there. Market order, you know, market order is an order to buy or sell at the prevailing market price. Okay, limit order. So suppose I want to, you know, take up buy a Nifty futures contract, but let's say I don't want to buy it at a current price. I want to buy it, let's say, when the price is 50 points lower. So I will place a limit buy order, right? I will place a buy order at a price which is lower than the current price. That is a limit order. And stop loss orders, they are meant for minimizing your loss. So suppose I have bought something, okay, and let's say, you know, I have placed a buy order in some stock futures, let's say at 120 rupees, and I'm worried what if the market goes down after I have bought this. So what I do, I put a stop loss order at 115, okay, 5 rupees below. So what will happen? Suppose I buy it at 120 and then subsequently the market price starts going down. Then the stop loss will be triggered, and at 115, my position will be sold off, right? Order routing is the next step. Order routing means once the client's order is punched into the broker system, the order is routed to the exchange server. And once it goes to the exchange server, it goes and sits in the electronic order book of the exchange where the exchange matches the order. Okay. And the exchange's rule is price time priority. What does it mean? It means that the exchange will rank all the buy orders and sell orders, right? So the buy order at the highest price that will be ranked first, right? And the sell order at the lowest price that will be ranked first, right? And if there are two orders at the same price, suppose there are two buy orders, both at the price of 100, then which one will get priority? The one which has been entered first. Okay, so if there are two orders at the same price, the order which has been punched in first, the timestamp, that will get priority. So this is known as the price time priority rule. And as per this rule, the exchange matches all buy and sell orders and executes them. And once the order is executed, the buyer and seller receive the confirmation details, right? And then once the trade is executed, then the ball goes into the court of the clearing house. The clearing house looks after the clearing and settlement, right? So it makes sure that whatever trades happen on the exchange platform, they are properly settled. And the other thing it may mention, other important function of the clearing exchange house is the risk management, right? So as I said, because it gives a settlement guarantee, the clearing house is exposed to a risk, right? What if the buyer fails to pay the money, right? Or what if the seller fails to deliver the security? In that case, the clearing house will have to step in and cover that default. So to protect itself from the default of either party, of either the buyer or the seller, the clearing house collects margins. Okay, so for any derivative contract, as I said earlier, when we take a position in a derivatives contract, we do not have to pay the complete price, right? We don't have to pay the full price, but we have to deposit a margin with the clearing house. And there are different kinds of margins which the clearinghouse collects. There is something called initial margin, then there is something called exposure margin, right? All these margins are collected by the clearinghouse. So this is all part of the risk management of the exchange. What are the risks associated with this derivatives? So the main risk is market risk. What do you mean by market risk? The market risk is also known as price risk, right? It is the risk that the price may go against you. I take a position in, say, Reliance Futures at when the price is 1200. And then let's say overnight, Trump announces some more tariffs against India or whatever. And, the next day the stock price crashes. Let's say the stock price crashes to 1150, right? So I have bought it at 1200 and now the price has crashed to 1150. So the market has moved against me. So the risk of loss due to unfavorable movements in the price, that is market risk. And what is liquidity risk? Liquidity risk is the risk that I am unable to, cover my position or get out of my position at a favorable price. Okay, so let's say I have bought some very illiquid stock and the next day the stock hits the lower circuit and I am unable to sell it, right? That is liquidity risk. And execution risk. Okay, execution risk is again, this is more common in an arbitrage transaction. Okay, risk that you had planned to buy some stock or some contract at say 100 rupees, but by the time you actually placed your order, the market had already run up. So you could not buy it at 100, maybe you could only buy it at 105. So execution risk is that you are not able to execute your orders in time. Okay, basis risk will not go into that. That is something connected with the futures, with hedging and everything. Regulatory risk is the risk that, regulations change. Government announces some sudden change in the regulations because of which, you end up with a loss. So all these risks are intensified because of the leverage nature of the derivative contracts. Okay. So these are all the risks. So before we conclude, we'll just look at a very simple example. Let's say there is an investor who holds equity shares in X Limited, and the investor would like to hold these shares for 3 months, but they are not sure about the market conditions in the near term. So his investment horizon is 3 months, but what are the alternatives? There is, let's say that the next 3 months are going to be volatile. So investor is not sure about the outlook for this company. So what alternatives are available? So let's say today the shares are trading at 1000. A futures contract is available at 1025, and there is a put option with a strike price of 1050, which is trading at a premium of 30 rupees, and a call option is trading at 10 rupees. The strike price is 1075. What are the alternatives available to this investor? So one thing is that, let's say the investor does not like the uncertainty, it doesn't know what is going to happen over the next 3 months. So one alternative is to sell the shares today itself, and whatever money they get, invest the sale proceeds in a money market instrument. Okay, let's say they can put it in a liquid mutual fund or something like that. And let's say that money market rate is 5%. So if they sell everything today and invest in the money market, they'll get 5% per annum. The second alternative is that they can sell the futures contract for hedging their investment. Third is buy a put option. Fourth alternative is sell a call option. And fifth alternative is not do anything. Okay, so let's look at the calculations. So let's say after 3 months, the stock is at 900 rupees. Okay, after 3 months, the stock has ended up at 900 rupees. So if they had gone for alternative one, what was the first alternative? Sell everything and invest in a money market instrument for 3 months. They would have ended up getting 1012.50, which is good, right? Which is better than getting 900. Okay. If they had not done anything, okay, last alternative, don't do anything. What would have happened? Their stock would have been worth only 900 at the end. Suppose they had sold a futures contract. Okay. Now remember, the futures was trading at 1025. So suppose they sold a futures contract, and at the end of 3 months, the contract, the stock is worth 1000, sorry, the stock is worth 900, right? So they would have made a profit of 125 rupees on the futures, right? And suppose they had sold the stock at 900, plus they would have got a profit of 125 on the futures. So in all, they would have got 1025, which is again very good. Okay. Suppose they had bought a put option, okay, by paying a premium of 30 rupees. Now see, the strike price of the put is 1050. Now if the stock ends at 900, then they would have made a profit of 150 on the put option. Sell the stock at 900, make a profit of 150 on the put option. So that makes it 1050, but they have already paid 30 rupees for that. So the net payoff would be 1020. Okay. And the fourth option was to sell a call option. Sell a call option. Why sell a call option? Because they think that most probably the price will go down over the 3 months. So they sell a call option for they receive a premium of 10 rupees. At the end of 3 months, suppose the stock is at 900, right? So the call option would not be exercised by the call buyer. So they end up getting a total of 910, which is better than getting just 900, right? So this is how the different scenarios will play out. So depending on what the price is at the end of 3 months, the different alternatives, whatever alternative that has been selected, there will be different outcomes. Okay. So it is very interesting. You can see which alternative they have to do. Okay. So doing nothing is a bad choice if the market is going down. If the stock goes up over 3 months, then doing nothing turns out to be the sensible alternative. But if the stock ends up lower, then doing nothing is going to cost the investor, right? So, so many alternatives are available, right? So that's all I have to say. I think I have run out of time. I had a few questions to ask, but since we are at the end of the session, I'll stop sharing my screen, and yes, I would like to take any questions.
There are some question in Q&A section.
Yeah. Can you read out the
Ma'am, you can
questions?
check it yourself. At your
Okay.
end.
Okay. Okay, there is a question. Please spend some time on pricing models. What kind of models are available and things? Yeah, see, this pricing models, This is a whole, big thing, topic. This itself would be a topic for 3 hours, okay? So this being just a 1 hour webinar, the purpose here was to just give an overview of equity derivatives. And it is not possible to cover pricing models in detail in such a short time. Okay, there is one question. What is call writing and put writing? Now, the meaning of writing means selling. Okay. So when we talk about options, as I said, there are two types of options, right? Call and put. And for both these options, you can either buy the option or you can sell the option. Okay. So it's not as if you can only buy a call. Many, beginners are under the misconception that calls can only be bought and put should be only be sold. So you can do both the things, you can either buy the option or you can sell the option. So option writing means option selling. Okay. So call writing means selling the call and put writing means selling the put. Okay. So I hope that answers your question. Uh, what other questions are there? Please explain what is OTC market. Okay, over the counter market or OTC market is a market where the buyer and the seller directly talk to each other and directly negotiate the trade. Okay, so for example, I don't know, the wholesale market. Okay, so let's say there is an APMC market in Vashi. Okay, in Mumbai, APMC market. Okay, vegetable market. That is an OTC market, right? Because the buyer and the seller of the vegetables, they directly talk to each other, right? Face to face, and they negotiate the price of the vegetables and everything. Okay. So buyer and seller directly contact each other and negotiate. And to give you the example of financial markets, for example, the Forex market. The Forex market is an OTC market. Why? Because say, what is a Forex market? It is a market where, different banks, they buy and sell foreign currency, okay, from each other. So let's say the dealer of State Bank of India, okay, Forex dealer from State Bank of India, he wants to buy, say, $100,000. What he will do, he will directly pick up the phone and talk to his counterpart at Citibank. And on the phone, they will enter into a deal. Or, there is something called the Reuters platform or the Bloomberg platform. They can directly enter into a deal on that platform, right? So when the buyer and seller directly negotiate the terms and directly talk to each other and buy and sell, that is called a OTC market, right?
Some
Okay.
questions are in the Q&A section.
Okay, I'm looking at the chat. Where is the Q&A section?
Near to that share option.
Okay, sorry, I was looking at the chat. Okay. Okay, so there is somebody who is saying, one second. What will happen if I buy call option for many lots but didn't sell the contract on expiry and I can't take the delivery of physical settlement? Okay, so you are basically saying that suppose you buy calls, okay, and so when you buy a call option, okay, say on say Reliance, so say for 20 lots of Reliance, and then your option is in the money on the expiry date, then you are supposed to take delivery of the shares by paying the strike price. Okay, but if you can't do that, right? So if you are unable to take delivery, maybe you don't have enough funds or something, then what will happen is that it will be a default. It will be treated as a default because you are unable to make the payment, right? You are unable to make the payment to your broker. So that will be treated as a default. And what the exchange will do, exchange will withhold delivery of the shares which was supposed to come to you, right? So you will not get delivery of the shares, and exchange will sell those shares in the market and will make the payment to the seller, right? And your broker will pursue you for that. Okay, so it will be treated as a default basically. Okay, and every default has penalties and fines and penalties and everything. So Those are the consequences. When one should initiate call writing or put writing. Okay. Now that is a more complex question, okay, for a beginner's webinar. So basically you are asking when you should sell a call or when you should sell a put. Okay. So the thumb rule is that see, options are a play on both the price movement as also the volatility movement. Okay. So if you are of the view that the underlying price is not going to be so basically, let's say you are looking at a stock which has run up very sharply. Let's say the stock has been running up over the last few weeks. Okay. Let's say it has already run up by 10%, and now you feel that it has hit a technical resistance. Okay. You feel that there is not going to be any upward movement now. Okay. For some time. But you also think that it is not likely to start crashing. So what is your view? Your view is that the stock has run up very sharply over the last few weeks, and now you think that it has now, it is not going to go up anymore. It will probably be range bound. So if that is the view, then you should be selling a call option. Why? Because stock is not going to move up any further. It's only going to trade range bound, right? So if you sell a call option, what happens is that you will get the premium, and stock is not going to move. So that's how. And when do you sell a put? Okay, so opposite case, let's say the stock price has been declining over the last few weeks and you think that now for now it has bottomed out. Okay, you think that it's not likely to fall any further. So in that case you might find it better to sell a put option. Okay, you will not immediately rush to buy a call option because there's no guarantee that it will start rising tomorrow itself, but at least you can be sure that it's not going to fall any further. Okay, so for example, something like, okay, and now obviously I can't give any stock recommendations here, but let's say there is a stock which has been falling from the level of rupees 500, and it has fallen all the way, and today the price is say let's say 220. So it has been falling from the level of 500, and now it has been trading in the range of 220 for the last 1 week. So you feel sure that it has hit the bottom, it's not going to fall any further. So you may sell a put option. Okay. So that's the thing, when you can sell a call, when you can sell a put. Okay. Uh, can we take personal loan and trade in options? Is there any legal issues? I don't think there are any legal issues, but I don't think it's a wise decision to take personal loans and trade in options. Okay, because as I said earlier, the market risk is very high. As you can see over the last few months, the market has been declining every day. Okay, and in options, oh, yeah, there is a possibility that you will make a huge amount of profit, but there is also an equal possibility that you can make huge losses. So taking a personal loan to trade in options is not a sensible decision. Okay. And I would strongly argue that you should not do that. Okay. Okay, you probably spoke of weekly expiries. Weekly expiry started way in 2016, okay, when Bank Nifty options were introduced by NSE. Okay, weekly Bank Nifty options were introduced in 2016, and weekly Nifty options were introduced in 2018, right? So since then they have become very popular, and till recently, on every day of the week we had some or the other option contract, which was expiring. So on Monday we had some contract. So basically there were around 5 indices on which weekly contracts were allowed. Okay. And recently SEBI has, said that every exchange will have only one weekly contract. Okay. So this thing.
Sorry to
What?
interrupt, but I think we are running short of time, so we'll take only two questions from the Q&A section.
Okay. So which one do I take? There are so many. Okay. What are the factors that affect forward markets? Okay. See, a forward contract is nothing but, there are only two factors which affect the forward contract. One is the time remaining till the maturity date, and the other is the interest rate. Apart from that, and obviously the price of the underlying. Okay. So if you're talking about, say, Nifty futures or anything, the three factors: the spot price of the that is the price of the underlying asset, the interest rate, and the time remaining till the expiry. Okay. Can you please explain option Greeks? Okay, now option Greeks, it's again an advanced topic, but basically what are option Greeks? These are the factors which, these are the basically what are Greeks. So every option, so just as I said, what are the factors which affect the forward price? It is the underlying price, the interest rate, and the time to expiry. What are the factors that affect an option price? Okay. So apart from the spot price, the risk-free rate, and the time remaining till maturity, there are two other things. One is the volatility of the underlying. Okay. So these are the factors which affect the option price. Okay. So now what do these Greeks capture? So for example, the option delta. Okay, so when I say that the options delta is 0.6, it means that if the spot price, so if the underlying stock price moves by 1 rupee, my option price will move by 60 paisa. Okay. And when I say that the option vega is say 2.3, what does it mean? It means that if the volatility of the underlying moves by 1%, then the option price will move by 2.3%. Okay, so the Greeks simply capture what is the effect of change in the underlying price, change in the underlying volatility, change in the number of days till expiry. What is the effect of all these factors on the price of the option? And because we use Greek letters to denote these effects, they are known as option Greeks, because delta, vega, gamma, theta, all these are basically Greek letters. Okay. Uh, okay. I think I've taken two questions. Neha, do we have time for anything further?
Um, so I think we have discussed all the questions which are important and which has been asked. We should, because we are running short of time, so we should end this webinar here. So thank you so much everyone for joining today's webinar. And I would like to express my heartfelt gratitude to all our esteemed speaker for sharing her expertise with us. A special thanks to you and to our audience for participation and engagement. For the participant, some instructions are here. Participation certificate will be sent in 3 to 4 days. The webinar recording will be available on the NISM YouTube channel. So I officially close today's session and stay connected with us for the future webinar. Thank you, everyone. Thank you so much. Have a great evening.